Good morning, everyone, and welcome to the Seraphim Space Investment Trust Interim Results webinar. I will shortly hand over to the Chief Executive, Mark Boggett, Chief Investment Officer, James Bruegger, and Chairman, Will Whitehorn, to run through the results presentation. Once the presentation has concluded, we will begin the Q&A. If you have a question, please use the raise your hand function and we will take you off mute. This presentation will also be recorded and will be made available on the website later. I will now pass you on to Will to begin the presentation.
Good morning, everybody. This is Will Whitehorn, Chair of Seraphim Space Investment Trust. When we first announced the results after we floated this company, we said that we believed that we could identify key drivers of space tech growth and that they were already underway. They were the geopolitics of climate change and defence and the monitoring of both of those areas and issues for governments. They were the commercial exploitation of data from new constellations and the introduction of new technologies in space, allowing much greater depth of data than ever before. One example of that kind of commercial exploitation would be the much and vastly growing use of space data by the insurance industry. The third driver is the industrialization of space, internet provision, data storage, and of course, in the long term, solar power from space. Now, the reality of where we are today is that these things have accelerated to a greater extent than even we thought 2 years ago. Governments now want sovereign capability in space, and they're prepared to buy that commercially because they're not going to get it any other way in the short or even medium term. Countries, including the UK, are powering ahead with space strategies. Indeed, our space industry strategy was launched last week by the UK government, and they want to make London a hub for investment in the space industry, and a global hub at that, which it has a good chance of achieving. SSIT and its portfolio benefits from all of this. ISI, for example, has grown faster than even we could have forecast 3 or 4 years ago and is now in profit. 6 others of our investments are either in profit or they have sufficient funds to reach profitability. There is a maturing outlook for this portfolio, and indeed, it's gone up in value just in the last period by £10.5 million to £198 million. Now, to go into the detail of what's happening at SSIT, I'm going to hand over to Mark Boggett, Chief Investment Officer of Seraphim. Thank you, Mark.
Thank you, Will. So before we dig into the detail of the interim report, I just wanted to take a step back to remind folks about the big picture for Seraphim. Seraphim is the most prolific investor in the space market globally, with a portfolio of over 100 space tech companies across our public and private portfolio. Seraphim was the first VC to launch in 2006 with a space-focused theme, and SSIT represents the one and only listed investment fund focused in space globally. Our partners and backers include some of the biggest space corporates globally, such as Airbus, MDA, and SES. And we continue to receive massive global deal flow. We're seeing virtually all deals at all stages, and this provides the investment team with an information asymmetry over the global sector. We triage our deal flow between early stage and late stage, with the earlier stage opportunities going to our affiliated accelerator program, which focuses on seed stage companies in space tech market. We're a value add, hands-on investor. We join the boards of the companies that we invest into, and this allows us to be able to build conviction about these businesses because we're operating alongside management team with deep insights. Information asymmetry and the conviction that provides us is the bedrock of our past and future success. Now, let's turn to SSIT and the interim results. So let's start off with the headlines. So the NAV per share has increased by 1.8% from 0.93 to 0.95 per share. The market's been pricing heavy falls in our valuation into our share price, and the share price was at 34.4 pence as at the 31st of December, with a discount of 64%. I'm pleased to report that the shares have rallied in the new year, today at over 50 pence, representing a significant narrowing of the gap and the discount now down to about 40%. Net assets of 224 million at the time of the interims at the 31st of December were valued at only 82 million pounds by the market. The left-hand chart shows the SSIT price performance rebased across a range of benchmarks, and the period shows considerable outperformance by the trust in all measures. On the right-hand side, we see the SSIT share price performance versus our AIC peer group. So these are private growth trusts like Chrysalis and Schiehallion, and you can see there that we've seen periods of relative outperformance in Q2 and Q3 of the calendar year and post-period in Q1. So during this presentation, I hope to convincingly explain why SSIT will be well positioned to continue to close the discount gap once sentiment starts to return towards technology and growth stage private companies. SSIT has a number of clear and increasingly evidenced drivers that mark us out differently to the generalist tech nature of those others in our AIC peer group. So let's start off by looking at the detail within this attribution analysis table. The value of the portfolio increased from 187 million to 198 million during the period. 2.5 million in new investments, 3.3 million in follow-ons during the period. An increase in unrealized fair value of 4.6 million, and the main driver of this was the underlying fair value increase in Deorbit, which was reflective of a 100 million euro transaction during the period that was partially offset by reductions in the fair value of a few other portfolio companies and an unrealized FX gain of 0.2 million during the period. Next, to turn to the balance sheet as at the 31st of December. This table sets out the NAV bridge. So NAV slightly increased over the period to 224.3 million. The portfolio fair value, including FX movements, increased by 4.8 million over the period. 2.2 million shares were bought back during the period at an aggregate cost of £1 million. And the NAV per share increased from 92.9 to 94.957 over the period. Importantly, I wanted to note that the portfolio is well capitalized. We hold 12% of NAV in cash and 26.8 million as at the 31st of December, when we continue to support the portfolio in the year ahead. So this is a portfolio snapshot over the period to the 31st of December. And over the 6 months, we've seen strong performance in the underlying portfolio. Private companies in the top 10 holdings accounted for 85% of NAV. The private company portfolios perform well, with the portfolio valuation of up by 5.6% to 198 million. And whilst the private companies are now valued at 21% above cost, the public portfolio of SPAC companies continued to perform poorly. Most of the underperformance was through Arcit, whilst Spire Global has been performing well, and AST closed a 155 million funding round, which was led by Google and AT&T. The key statistic on this page is the 60% figure. Let me help unpack this statistic. 7 companies representing 60% of the fair value are now either profitable or fully funded to cash flow break even based on the projections of their respective management teams. And one of the key announcements of this period is that ISI, our largest portfolio company by NAV at 20%, has become EBITDA positive. A further 22% of fair value of the portfolio companies are funded over the next 12 months to the 31st of December 2024. So these figures will hopefully give you increased confidence that the SSIT portfolio is maturing and is well capitalized. Turning next to the investments. 6 transactions, £5.7 million invested over the period. We continue to make small investments, but for the purposes of today's presentation, I'm going to focus on the growth stage assets that can move the needle on NAV in the short and medium term. The biggest investment in the period was a follow-on investment into the UK-based antenna manufacturer All.Space. During the period, the business signed a large non-dilutive contract from a US defense customer in excess of $10 million. In addition, during the period, Seraphim invested 2.9 million pro rata to other shareholders. A new chairman was appointed, Mr. Chris Emerson, a respected former aerospace executive who previously served as chairman and CEO of Airbus US Space and Defense. I believe this is a great indicator that this company is really getting ready for the big time. All.Space is an important portfolio to Seraphim, ranked third in our NAV weighting, and this company is at a pivotal point. They're just delivering on their first customer orders for their unique antenna systems. They've developed an electronic antenna that's specific for moving platforms such as cars and boats, planes, trains, tanks, which can connect them to any satellite in any orbit. And the company has a range of contracts with government and defense customers that are eager to access this capability. It's got defense customers in the US, the UK, and Asia, along with commercial customers such as SES. Next is the new investment into a company called Skylo. Now, this is a company and an opportunity that we've tracked for the last 2 years. So Skylo is making always-on connectivity a reality for today. The company is a telecoms provider, allowing customers to connect with their mobile phones and also any IoT endpoints to existing satellites when they're outside of terrestrial covering. So Skylo does this through actually connecting the legacy geostationary satellites to any Android phone without the need for any proprietary hardware or software on that phone. So this enables, through roaming, text messages and, in the future, WhatsApp messaging. The company's rolling this out next quarter as the next generation of chips in mobile handsets enables their technology to work seamlessly. So Skylo raised $37 million from Intel Capital, Innovation Endeavors, BMW Ventures, Samsung Catalyst, and Seraphim Space. And the company expects that this funding round will take them through to cash flow break even. So now we turn to key developments in the portfolio during the period. And as I've already mentioned, the key standout feature for this quarter is that ICEYE, our largest portfolio company, has reached EBITDA profitability, an enormous achievement for this market-leading radar business, which also launched 2 new satellites outside of the period, taking their constellation up to 34 satellites. Deorbit was a key driver for the valuation uplift during this period on the back of closing a €100 million round, which was led by the Japanese corporate Marubeni. This business continues to develop a leading position in the space logistics market, recently completing its 13th successful space taxi mission. They continue to consolidate their position in this market, and an exciting aspect of this business is its plans to become the RAC, or the AA of space, using its empty taxis. Once they've delivered their clients to their specific orbits, they'll then be able to undertake a secondary business model, removing satellites that have reached the end of their life or have broken and need replacing and need removing in order to avoid for future space junk. So this is a market that's becoming increasingly regulated, and with Deorbit providing the very services that the regulator is demanding that companies are seeking in order to achieve a launch. So Hawkeye 360 flexed its healthy balance sheet with more than $100 million. That's following the BlackRock-led round, which happened during the quarter. They have also made an acquisition of a division of Maxar to strengthen their RF capability. And we anticipate further M&A by Hawkeye in the year ahead. So sales performance of this business has been very robust. Next, Tomorrow.io achieved 2 key milestones, one closing a $99 million equity round, and second, gaining space heritage for its first 2 satellites in orbit. Now, this company took a different path to our other portfolio companies, starting life as a software-only data analytics company and then adding satellites to their capability so that they could procure their own weather data. Sales performance of this business likewise has been very robust. The next two companies to talk about include Voyager Space, which we describe as the next generation space prime. So during this quarter, two major developments occurred. Firstly, Voyager and Airbus announced their plans for a joint venture to create Starlab, a free-flying space station. So this is to replace the ISS when it's decommissioned at the end of the decade. So Starlab is going to provide and host facilities for public and private astronauts, and will also form critical infrastructure to support research and development and manufacturing in space. Furthermore, as the evidence of their increasing strength and position in the market, Northrop Grumman announced that it's going to drop its own plans to develop its own commercial space station and instead assist in competing the efforts that are led by Voyager Space. So the final company to talk about by way of update for this period is our Earth observation company, Satellite View. So they reached a major milestone before the period where they launched their first pilot satellite into orbit, which was working well and started to generate significant revenues. However, this satellite recently experienced an anomaly, and after 6 months of operations, the satellite had a component that failed that impacted their commercial operations. So this company is not going to be able to provide any more imagery until the next satellite can be launched. So the company is working on this at the moment with its suppliers, which is progressing well, and is expected to launch its next satellite in Q1. So current expectations are also for a full payout from the insurance in the next quarter for the satellite that has unfortunately failed. So this slide provides a snapshot of the portfolio. So drawing some insights from the donuts on the left into the ecosystem chart in the top right, more than half of the portfolio is invested in platform. And this means satellite constellations. These are businesses that are developing the digital platform in the sky that's providing capability of data and insights from large fleets of low-cost satellites. The bigger customers for these companies today is defense. And given the considerable increase in defense budgets because of the geopolitical situation, these businesses are really thriving. In relation to geography, it's pretty much evenly balanced between the US, Europe, and the UK. And in relation to the stage, as can be seen in the bottom left-hand chart, 75% of the value is in the growth rounds of the C and D series. So turning our attention to the NAV chart on the right, the top 10 companies dominate NAV, accounting for 75% with cash at 12%. ICEYE is the largest holding in the portfolio at 20% of NAV, and this is one of the portfolio companies that we doubled down on because of the level of our conviction. That conviction is now paying off, as this is our best performing business and it's performing exceptionally well on all measures and has now reached profitability. In relation to fundraising over the period, 8 companies successfully raised funding rounds, and 6 had participation or were led by external investors. So this participation from external investors demonstrates the attractiveness of these portfolio companies to new investors. 3 companies raised flat or up rounds, which is a testament to the strong performance of these companies. And 3 companies closed rounds at reduced valuations relative to their previous round. In 2 instances, this was due to underperformance versus previous expectations. And in the other instance, the round was significant and represented over a modest reduction over the previous round, which was actually raised at the height of the market in 2021. So in relation to cash runway, the management teams of 7 of the portfolio companies, that's 5 which were in our top 10 holdings, are now projecting that the companies are fully funded and don't need to raise any more capital to reach cash flow break even. Excluding the fully funded companies, the remainder of the portfolio has a fair weighted average cash runway of over 12 months. So we're really confident about our cash position and the cash that's on the balance sheet of our portfolio companies. So this is the final slide before we open to Q&A. So I'm just going to summarize the year, which is really that space tech has been very resilient during the last 6 to 12 months. Whilst general VC investment saw a 35% drop in investment between 2022 and 2023, space tech substantially outperformed. 2023 saw a total investment of 6.8 billion, which was effectively in line with 2022. In terms of M&A, these well-financed new space businesses have been prolific acquirers during the period. There's been around 30 M&A transactions. However, the largest transactions were conducted by private equity and corporates, so including L3Harris and their acquisition of Aerojet, BAE's acquisition of Ball Aerospace. But one of the two key transactions that occurred were KKR's take private of OHB and Advent's Maxar take private. Eutelsat and merger OneWeb is also something to note that happened during the period. In terms of the outlook for the year ahead, geopolitical tensions are still continuing to drive defence budgets. They're at record highs, and PE investors are positioning themselves to invest into companies that will ultimately access these budgets. So the defence sector is buoyant. It's a highly acquisitive sector. So we expect to see continued development in M&A during the period. We also see considerable investment from climate and impact funds participating in equity rounds. There's billions of dollars in dry powder in these funds, and we anticipate a continued upswing in their interest in space-related innovation in the companies that address the climate and sustainability issues. In the year ahead, we also expect sovereign wealth funds to become a feature of the market as both a customer and as an investor, as countries around the world seek to develop sovereign capability in space. So as such, we expect to see these three pools of motivated investment capital underpinning the continued upswing in the volume and value of space-related transactions. So SSAT continues to be well capitalized, and with the cash position at 27 million at the end of the period, and 82% of the portfolio by fair value with a robust cash runway, 60% of fair value fully funded based on latest projections from the management teams, and the balance on average funded for the next 12 months, we have a positive outlook for the year ahead and beyond. So thank you very much for your attention this morning. Myself and James Bruegger are now open to take questions.
Thank you very much. Just as a reminder, if you'd like to ask a question, please use the raise your hand function and we will take you off mute so you can ask your question to the team. So firstly, we have Shavar. I'm just going to take you off mute now.
Hello, can you hear me?
Yes.
Perfect. Hi, guys. Well, I would say congratulations on share price performance so far year to date. You're the performer in the sector, but still obviously quite a sizable discount. Good news, I guess, on ISI. Can we dig a little bit into the guidance there on profitability and EBITDA, etc. So in terms of these 7 companies representing 60% of NAV, you said they are all either cash flow profitable or funded to profitability. And so with respect to ISI, you noted they're EBITDA positive, so they are not yet cash flow positive, but will be in 2024. Is that the right interpretation?
I'll ask my colleague James Bruegger to respond to your question.
Yeah, so Shavar, there is obviously a difference between being EBITDA profitable, i.e. at the P&L level, rather than cash flow positive. So the guidance that we've given on the companies that you've alluded to is that based on their own projections that they've provided to us, they expect that the current cash reserves that they have are sufficient to continue to operate the business through until such a time that they become cash flow positive. Clearly, along that continuum, those businesses will, in most instances, in the first hand, turn EBITDA profitable. So we're able to give guidance today around, in several instances, businesses either already being at EBITDA profitability, as is the case with ISI, or with expectations from the management team of getting there within the next 12 months. But you're equally right to assert that in most instances, those businesses are not yet cash flow positive, albeit, as I say, given the cash reserves that those companies have in most instances, they don't believe that they're going to require to raise additional capital in order to reach cash flow break even.
Thank you. And have you are you willing to disclose, is there anybody except ISI that is EBITDA positive?
As of today, that is the only one of our portfolio companies that we're in a position to disclose that information on at this point in time, albeit as we've said, expectations are for a number of our other both private and public holdings to also reach that milestone during the course of 2024.
Thank you. And then in terms of cash runway, I believe 18% of the portfolio has cash flow runway for less than 12 months. Do you believe any of them require significant funding?
So I guess my response on that, and I'll allow Mark to chime in, is that the typical cycle of fundraising in venture capital is on a 12 to 18 month cadence. So it's very normal for a proportion of the portfolio to perhaps have less than 12 months cash runway. As we've reported both in this set of results and previous ones, our portfolio companies have been very successful at fundraising, both from existing investors and new investors. And although there are a number of companies that do need to raise rounds during the course of the rest of 2024, we have every confidence sat here today that, as has been the case with every single portfolio company since the inception of SSIT, these businesses have been able to access the capital when required.
Thank you. And then maybe last for me, to give other people the opportunity, can you speak a little bit about the prospects for the lease portfolio, maybe with regard to the 200 million raised by Fake Mobile, and are there any IPO preparations in your portfolio or expected more widely?
So we're not in a position today to talk about specifics, clearly. However, there are a number of our more mature companies that certainly have aspirations to go public, but are clearly cognizant of current market conditions. So I think the general focus within our management teams is to continue to scale revenues and drive towards profitability ahead of then potentially considering opportunities for IPO. So we would expect those sort of liquidity opportunities to probably come more likely in 2025 than in 2024, albeit there are one or two candidates that could potentially surprise subject to market conditions.
Thank you very much, Siobhan. We next have Will Crichton. If you could, I'm just going to ask you to unmute yourself, and we'd love to hear your question.
Morning, guys. The first one from me is relating to that 60% of the portfolio, which is fully funded. Has that only recently become fully funded, or has it just not been highlighted so much in previous reporting? And will these companies still be looking to raise to fuel growth, despite not being required to?
Yeah, so I'll take that, and Mark, again, please feel free to chime in. So this is the first opportunity where we've had sufficient visibility on these companies providing their own projections that indicate that they are fully funded through. So this is a relatively recent development that I think you can take as having arrived relatively in lockstep with the fact that a number of these companies are now approaching EBITDA profitability, and therefore by inference are requiring less capital going forwards. In terms of the second part of your question of does that necessarily mean that they won't be raising money? No, you're quite right. There are potential scenarios where some of these businesses may still decide to raise additional capital to both fuel growth, but also potentially to finance potential M&A opportunities that they are looking at. Mark has alluded to the fact that we've now started to see modest amounts of M&A activity within the portfolio, most notably Hawkeye 360's acquisition from Maxar. We would anticipate, as I think we've guided in the report, that our better capitalized, better performing companies, we would expect will have opportunities to potentially look at bolt-on acquisitions, either to add inorganic revenue or new strategic capabilities over the course of the next 1 to 2 years. And in some instances, it might well make sense for those companies to look to raise additional capital, which could be either equity or debt or a combination of the two, in order to fund those sort of activities.
Yeah, makes sense. Thanks. And I'll just do my last two in one go. Would you expect to see an increase in the satellite view valuation for the next quarter, should they successfully replace that satellite? And then just lastly, what's the probability that we'll see buybacks again on the trust?
I'll take the satellite view bit, and then I'll hand over to Mark for the buyback. So yes, we have reduced the valuation of satellite view to reflect this disappointing setback. Worth noting the very significant progress the business had made in the preceding 6 months that has retired the technical risk, if not the reliability risk, of their satellite design, and also delivered very strong validation of market demand. As Mark guided, it is unfortunately going to be a little while before the next satellite is in orbit. It's Q1 of next year. These are quite large, expensive satellites, and I think realistically, we probably wouldn't anticipate any meaningful changes in valuation that we've published today ahead of that next milestone of having a replacement satellite launched.
So on the buyback front, the board regularly keeps the buyback under review. The buyback that we undertook during the course of the period, was successful whilst we were in the process of the buyback, but as soon as we stopped, the share price reverted back to where it started before. So we're currently of the mind that the capital that we've got remaining is best positioned to support the portfolio and to make limited new investment opportunities where we're taking advantage of current market conditions and pricing for companies like Skylo to be added to the portfolio. So in short, the answer is there's nothing immediately in plan, but the board has that under review.
I think I can add to that, Mark, that we wouldn't hesitate to do it if the circumstances dictated that we thought it was the right thing to do.
Thank you, Will.
Thank you very much.
Thank you, Will. Next, we have Gavin. If you could unmute yourself, we'd love to hear your question as well. Thank you.
Morning, gents. I think you've largely ticked it off on the back of Will's questions there, actually, from what you said there, Mark. Just really looking at sort of that cash balance now, how you're looking to balance that, how you're looking to allocate that going forward. And I guess there are lots of interest in the space sector currently. In terms of your sort of pipeline and potential new investments, are you seeing that tick up a lot? And how's the sort of deal flow pipeline looking for you?
James, do you want to take that?
Yeah, so Gavin, no real change from the previous guidance that we've provided over the course of the last year, which is that we're anticipating deploying the majority of the remaining capital to continue to support the existing portfolio. We now have a portfolio of more than 30 companies, and therefore we're being very discerning and very selective in potential new additions. We continue to believe that it is appropriate to remain active in the market on a very selective basis in terms of increasing the portfolio, mindful of the fact that at this point in the economic cycle, it's very typical in venture that some of the very best investment opportunities manifest themselves, and we think that Skylo is a great example of that. So yes, we expect to continue being active, but probably not on a meaningfully different cadence from that which we've shown really since the markets turned in Q1 of 2022.
Great, thank you.
Thank you, Gavin. We now have the final question from Chris. If you could take yourself off mute, we'll hear your question now.
Morning, everyone. Just a couple of questions really on the cash, I suppose. So where you've not been able to follow your money with some of, because we read, I think, over $185 million of capital raised by existing companies. Clearly, you've not been able to follow that many of them. Can you just confirm that hasn't had an adverse impact on any of your existing investments? Question number one. And question number two really was just, given ongoing charges imply around about 4 to 5 million of cash burn a year, just where you would feel comfortable sort of taking that cash level down to. So I think it's about 26 million. Have there been any other investments or money spent since the period end?
Again, I'll ask James to address those questions.
Sorry, Chris, do you mind repeating the first part of your first question?
Yeah, no, it was just on the obviously a lot of the underlying companies have raised a lot of money over the period, over $185 million.
Yeah.
I think you were able to take part in a relatively small number of follow-ons. I just wondered where you weren't able to take part, whether that had any adverse impact on the valuations of your holdings in those businesses.
Yes. Well, first thing to say, just to clarify, is we have participated in the majority of financing rounds that have occurred. But you're right. In certain circumstances, we have elected to take a certain proportion of dilution. That's a function of whether or not we decide to participate in the round, and the extent to which we participate, whether we're participating pro rata to our existing holding, in which case we would suffer no dilution, versus investing less than our pro rata, in which case we would face some dilution. I think the guidance that we can give is that where we have taken dilution, and again, I would call out that this is a very normal feature of any venture fund. As your companies progress, given the sort of levels of capital that they're raising, you would expect your ownership stake to reduce somewhat over time. But that to date, where we have taken dilution, it has been at only a very modest level and hasn't unduly had an adverse impact on the implied value of our holdings. Critical other point to call out here is that in any funding round, the impact on valuation is a combination of the pricing of the round and obviously how dilutive that round is. So for example, if one of our portfolio companies raises a round that's at twice the value of the last round and is selling a 10% ownership in the business, clearly that would in that combination of circumstances, that would relate to a significant increase in the carrying value of our holding, even if we did not participate. So I hope that provides clarity you were seeking.
Yes. I was less interested, I suppose, in the dilution in your percentage stake, but more in whether the economics, I suppose. And I think you mentioned there were about 3 down rounds, so I suppose that would be the key feature, wouldn't it? Really?
Yes. So again, just to clarify specifically around the down rounds, in most instances, as we've articulated in previous quarters reports, we benefit from various downside protections, most specifically liquidation preferences, which mean that we get a prioritized return over other share classes, and also anti-dilution protection, which gives you some degree of protection from dilution where rounds are priced at a significantly lower level than the previous round. So again, to continue with the guidance that I provided, those 3 down rounds have not resulted in a material negative impact on either our value or our ownership of those underlying companies.
Thank you.
Thank you, Chris. We have another question from Shavar. If we, I'll just take you off mute now, and we'll hear from you, and that will be probably the last question for the presentation.
Thank you. Given that we have a little bit of time, I was hoping I could ask a little bit more. So maybe just to come back and close this off, ISI is the only company that has positive EBITDA in the portfolio right now. Is that correct?
It is the only one that we're in a position to disclose that information about.
Yeah, it's not correct, but it's the only one that we've got permission to publicly announce.
Okay, well, that is an important distinction. So are you able to say how many companies anonymously have positive EBITDA?
We're only in a position to give the guidance that we've provided in this report, which is that a modest number of companies, I believe it is 3, are either at or projected to reach EBITDA profitability this year. However, those are some of our more meaningful holdings that collectively represent about 40% of portfolio value. So there is a clear correlation there between our largest holdings, our most mature holdings, and those that are now approaching both profitability and being sufficiently well capitalized to not need to raise additional funds.
That is really helpful. I'm happy I was able to add the clarification. But in terms of the valuation methodology, your terminology in your reporting, saying the valuation method is the calibrated price of recent investment. Can you give a little bit more detail on that to sort of give people confidence on how you're coming up with the valuation?
Well, the short answer is there's been no change in how we approach our valuation methodology from that we have consistently articulated. So we adhere, as virtually every venture capital and private equity fund globally does, to the IPEV valuation guidelines. Those guidelines recommend that based on the relative stage and maturity of a business, different valuation methodologies may be applied to try and determine fair value. For businesses that are still in growth stage or in very early revenues or indeed pre-revenues, then you're right. Calibration against the price of a recent round is one of the key variables that is assessed. But as we have disclosed in previous quarters, once a business has gone a meaningful period of time, so that's sort of between 6 and 12 months without an external financing round, then we then look to recalibrate valuation against a whole range of both internal and external metrics to try and refresh the valuation, which we are doing on a very periodic basis with all of our holdings.
Okay. But so for all of these companies that have recently raised, your valuation is pretty much close to the valuation that they raised at. Is it fair to assume?
Well, other than those where obviously we've either signified that there has been a change positively, or where there has been a provision due to some combination of setback, as was obviously the case with Satellite Vu, with the unfortunate news about the satellite, or underperformance, which again we have highlighted both in this report and previously. But yes, I think it's fair to say that as a rule, valuations are calibrated fairly closely to the price of recent rounds, with exceptions for both under and over performance.
Yeah, thank you. Very helpful.
Thank you very much for all of your questions, everyone. That now completes the Q&A round, and I'll hand back over to Mark and the team for any closing remarks that they might have.
Yeah, well, firstly, I'd just like to thank everyone on the call for their interest in Seraphim Space Investment Trust. Hopefully, what we've been able to demonstrate is a continued progression of the fund and the portfolio companies towards maturity. The key drivers of the market, defence and climate, are accelerating, and that has led to a number of companies now getting to EBITDA positive and to the position where they've raised sufficient capital that they don't need to raise any further to reach cash flow break even. We're really positive about the portfolio and the outlook for the market, and hopefully that's come through in our reports and in the narrative around the presentation today.
And finally, as they say, from the other private sector and government work that I do in space, I can clearly discern that we're in a full-scale industrial revolution in space, and it's in a relatively early stage at the moment. But the Prometheus, as they once said in the economic history book, is definitely unbound now and heading towards a space economy. Thank you.
Thank you.